Let's kick off this deep dive on Equinix with how the stock has performed this week. On Friday, April 10th, shares closed down 0.13% at $1,030.24. But looking at the week overall, Equinix was up 3.08% from Monday's open. The stock is trading near its 52-week high of $1,039.90, having climbed from a low of $710 earlier this year. With an RSI of 73.3, the stock is technically overbought, meaning it might be due for a pullback. Now let's get under the hood and see what the fundamentals say. Welcome to the StokTok deep dive on Equinix Incorporated, ticker EQIX. This data center giant makes money by providing co-location services and interconnection platforms where businesses house their servers and connect to cloud providers. Our StokTok score gives Equinix just 27 out of 100, signaling a void. This score covers 5 key dimensions: valuation, financial health, profitability, growth, and smart money activity. Let's talk valuation. Is Equinix cheap or expensive? The numbers paint a concerning picture. With a price-to-earnings ratio of 74.73, investors are paying nearly $75 for every dollar of earnings. That's extremely expensive compared to the market average of around 20. The PEG ratio of 7.64 is also alarming. Anything above 1.5 suggests overvaluation. The price-to-sales ratio sits at nearly 11 times, meaning you're paying $11 for every dollar of revenue. GuruFocus calculates the fair value at $885, but the stock trades at $1,027. That's a negative margin of safety of 16.45%, meaning you're paying a significant premium. Simply put, Equinix earns 0 points out of 20 for valuation because it's dramatically overpriced. How's Equinix's financial health? Think of these metrics like a credit score for the company. The Piotroski F-score gives us 5 out of 9 points, which is mediocre. It measures fundamental strength across profitability, leverage, and efficiency. The Altman Z score of 2.57 puts Equinix in the gray zone, meaning there's some financial stress but not immediate bankruptcy risk. A score above 3 would be safe. The company has concerning debt levels with a debt-to-equity ratio of 1.61, meaning they owe $1.61 for every dollar of shareholder equity. Their cash-to-debt ratio is just 0.14, showing limited cash to cover obligations. Interest coverage of 3.73 times means they can pay interest expenses, but it's not particularly strong. Overall, Equinix scores 8 out of 20 points for financial health. Let's examine profitability. How good is Equinix at making money? Return on invested capital, or ROIC, is the key metric here. It measures how much profit the company squeezes from every dollar invested. Equinix's ROIC of 5.14% is disappointing. Anything above 15% is excellent, while below 8% is weak. The gross margin of 51% shows decent pricing power, meaning they keep about half of every sales dollar after direct costs. Operating margin of 21% and net margin of 14.65% are respectable for a capital-intensive business. However, the free cash flow margin is negative 4.34%, which is concerning because it means the company is burning cash after accounting for capital expenditures needed to maintain operations. This negative cash generation is a red flag for investors seeking income or growth. Now for growth. Is Equinix expanding? The 3-year revenue growth rate of 8.3% is solid but not spectacular. Anything above 10% is considered good growth, while above 20% is high growth. The 5-year rate of 7% shows the company is growing but at a decelerating pace. This slowdown is concerning for a technology-adjacent company that should benefit from digital transformation trends. Book value growth of 5.1% over 3 years is modest, representing how much shareholder equity is growing per year. For income investors, Equinix offers a dividend yield of 1.85%, which is relatively low. The company's growth profile earns 9 out of 20 points because while it's growing, the pace is slowing and doesn't justify the premium valuation. In today's competitive data center market, Investors expect stronger growth rates to support such high multiples. What's smart money doing with Equinix? This is where things get really interesting. Only 9 top-tier investment gurus currently hold positions in Equinix, which is relatively few for a large-cap stock. More concerning, just 6.1% of institutional 13F filers are net buyers. Anything above 50% would signal bullish sentiment from professional investors. The smart money appears to be heading for the exits. Insider ownership is extremely low at just 0.66%, meaning management has very little skin in the game. This is a red flag because you want executives to own meaningful stakes in their own company. Even worse, looking at recent insider transactions over the past 3 months, there were 0 insider purchases but 34 insider sales. When company executives are selling their own stock while retail investors are buying, that's usually not a good sign. Notable Guru holders like Christopher Davis and First Eagle Investment Management have both reduced their positions recently, with First Eagle cutting their stake by 17.72%. The smart money activity earns just 2 out of 20 points. Here's the verdict on Equinix. The StokTok score breakdown shows 0 points for valuation due to extreme overpricing, 8 points for financial health with concerning debt levels, 8 points for profitability despite negative free cash flow, 9 points for modest but slowing growth, and just 2 points for smart money as insiders dump shares. This adds up to 27 out of 100, a clear avoid signal. While Equinix operates in a growing industry and has decent margins, the stock price has run far ahead of fundamentals. Trading at 74 times earnings with negative free cash flow and insider selling suggests this party might be ending soon. Sometimes the best investment decision is knowing when to stay away. That's the deep dive on EQIX. Don't forget to subscribe to StokTok. We break down the bull and bear case for every stock, every day.